Hey traders, John Howell here. In today's video, I'm going to be covering this article here from Zero Hedge about the next leg down, and also going to be covering this image here, which is depression dominoes fall image. I'm also going to be talking about Facebook. Facebook's crushed earnings and share prices are jumping. Amazon did the exact same thing. Share prices have gone through the roof, and Apple is doing all the same thing as well too. But hang on a minute. There's articles out here saying, is the Nasdaq about to collapse? I'm going to share with you what I think is happening within the tech companies and the tech stocks, what's happening right now, and what's likely to happen moving forward. So let's get straight into it. Don't place a trade based on what you'll see in this video, because there is no guarantees of making a profit in the market. It takes you a long time to become a good trader. So this video here is just to educate you to become a much better trader. Alrighty traders, so the very first article here, which is the Zero Hedge, the next leg down article, the top 10% are about to get hit. Now this is the image that they put up here. So this is all about the top 10%. And you can see here, depression dominoes fall. So the very first domino here is pandemic triggers massive layoffs, uncertainty in the new normal, capital and trade flows disrupted. Then the next domino here is high cost small businesses fold, money velocity collapse as savings soar. See, and that's actually what's happening right now. Now, the next domino, which is zombie corporations rush to borrow billions, but this only delays their insolvency. The next domino through here is service sector dependent on the top 5% of household spending implodes. Tech/material class lays off surprise protected class. The next one here, I can't even say a lot of these big words. Don't use big words, guys, all right? The next domino here is state and local taxes plummet. Now, the reason why that's happened, right, because no one is actually working, or more than 50% of people are working that run it. Federal bailouts run out, local government employment slash. Now, we're going to be getting more bailout from there. That's actually going to be putting a lot more pressure on the dollar, continued what's happening right now. So even though the very first thing here is state and local taxes plummet, that means the government's taking in less taxes. The really bad thing is that they're taking in less taxes, but they're printing more money. That's actually a really bad scenario. And the bailouts run out. They'll be doing more bailouts. Look, the government's just going to keep printing more and more and more money. And that's the reason why we're going to see, we're getting towards the end of this money, and we're going to be seeing very shortly within the next 5 years, we're going to start to see defaults, the government debt defaults and restructuring, and it's going to get really, really bad, because right now less money's coming in, more money's going out. It's going to be really, really bad, especially when inflation really starts to pick up, which already is starting to happen right now. Now, the next domino is defaults and bankruptcies. That's already happening as we speak. Explode higher, which it's happening right now as we speak, but it's probably like towards the end of this year, maybe even the start of next year, we're probably likely to even see a lot more, because as this continues, reopen, shut down, reopen, shut down, reopen, shut down is happening, it's hurting a lot of companies out there, triggering catastrophic losses in banking and derivatives. So the bankings are likely to get hurt. That's the reason why if you see things like JP Morgan and some of these big banks out there, they're actually still near their lows of when the whole crash actually happened. And then the very last company here is safe sectors crushed. Tech, healthcare, higher education, finance, no safe havens left. Well, I agree and disagree. I agree with, yes, I truly believe that that tech, healthcare, and all education and these companies out there are going to get hurt, right? So, but I don't believe on the short term. I think on the short term, we're in a massive bubble, and the bubble's likely to continue on the Nasdaq. That is S&P 500 and Dow and those sort of companies. They're probably going to keep getting hurt. But it's the tech companies, just like I'm going to share with you in a minute, that I truly believe are likely to continue up in the short term. That is, right. We're going to continue this bubble here, but in the long term, after this bubble is done and over with, that yes, tech, healthcare, higher education, finance, these companies, banking sectors, they're going to get hurt for the next couple of years. Government and all that sort of stuff are going to get really, really hurt. So no safe havens left. I don't agree with that. I think the safe havens for me personally are things like GDX and GDXJ. some of the mining stocks. Not all mining stocks, by the way, guys. Not all mining stocks. I'm liking of silver as well too, and also some gold. Right now, not gold because gold's almost at all-time new highs, so that's not much of a safe haven for me. But moving forward, I see right now that yes, tech companies are likely to continue going up, but then overall, I see the gold mining stocks, especially the ETFs there, and also silver right now, because they haven't actually made they have not made a very big move yet, so they're probably likely to see the safe haven. Let me know what you think in the comment section below. What do you think is going to happen to the tech sector? Do you think, one, the tech sector is likely to just continue going up in this bubble fashion and just keep being in a big bubble fashion? Or do you think we start to bust here? And also, what do you think are going to be the safe havens moving forward over the next couple of years as things really start to unravel? So based on what I was saying with that there, guys, we see that there's articles here from, you can see here, what ad boycott, and the reason why what ad boycott, because I think there was something like 7 billion, there was articles going around how Facebook ads are going to plummet and their revenue is going to plummet because I think there was something like 7 billion of people, 7 billion, I think it was something like that their ads are not going to, 7 billion in funding from different big companies out there have stopped buying ads. So they're probably going to lose 7 billion, whatever. And so what actually happened here was, these companies that stopped advertising on Facebook, they thought that Facebook wasn't going to have a good quarter. Well, Facebook share jumps after crushing every major metric through here. You can see here that Facebook's earnings per share was $1.80, but the estimate was $1.39. And if I scroll down here, you can see that their Facebook two-quarter revenue was $18.69 billion. The estimate was $17 billion. That's actually 11% growth year on year, and as you can see through there, so we actually had a bit of a dip in. Let's have a look through. So you can see here that the end of last year they had a massive spike. Then they had a bit of a dip in the first quarter, and now they're actually starting to pick back up as well too. There is still a lot of people advertising, and a lot of marketers are still advertising big time when it comes to Facebook. Moving over now to the Amazon soars after smashing expectations, guiding sharply higher. This is another tech company, and this is one of the reasons why I believe we're in the middle of the bubble, not towards the end of the bubble. And I'll talk more about that in a minute. So we're seeing right now that heading into today's earnings call, sees almost 5 trillion in market cap amongst 4 companies. Yes, we also can see that we can see that Q2 revenues of 88.9 billion. The expectations was 81 billion. Isn't that crazy? Isn't that this numbers here is absolutely crazy. Revenue of 88.9 billion in 3 months. Now the expectations were 81 million, so they smashed there. Earnings per share of a whopping 10.3 versus 1.5, 1.51, right? Absolutely just smashed it. As we noted, Amazon said it spent over 4 billion in incremental cost. COVID costs through there. And also Apple as well too. Apple soars above 400 for the first time on a blockbuster earnings, announcing 4-to-1 split. And so you can see here that the revenues of the 59.7 billion, smashing the estimates of 52 billion. Earnings per share of 2.58, also sharply above the estimates of 2.07s. iPhone's revenue grew, which is really interesting. iPhone's revenue grew, which I had a graph a while ago, and it was like, iPhones are not selling quite well. Samsung's selling is not selling well, but the iPhone's revenue grew from 1.7% to 26 billion. Service sector grew 15% to 13.2 billion. You see that the iPhones are still a large chunk of their revenue. Mac sales were up to 7 billion. Okay, and iPad revenue is only 6.6 billion. So wearable homes and accessory jumps 17%. This is something that I don't like about Apple. I recently bought my daughter and my son both MacBook Airs, and you know they've even got now different chargers for. They've got different chargers now for their laptops. And you've got to buy you've got to buy a USB adapter if you want to use there's all this crazy stuff. That's where I think it's not really good from Apple. But you can see here that iPhones grew to 26.4 billion, and you can see that that's what's going on through there. But we're also seeing a lot of articles like this here. Is Nasdaq about to collapse? Etc, etc, etc. And we're seeing a lot of these things here. So here's what I truly believe is what's happening here. Yes, valuations are crazy right now. Absolutely crazy right now. But I truly believe the Nasdaq and these tech companies, the major tech companies, are going to continue going through the roof. And because we're in a bubble. And so when the bubble ends, we never know. So I truly believe that right now, the bubble's going to continue with these major tech companies. They're just going to keep going through the roof. On the flip side of that, I truly believe we're in the middle of that melt up as we're happening as where we are right now. Then I truly believe that we're going to start to see after a period of time, I don't know exactly what, but I truly see Amazon, Netflix, Apple, Facebook, these companies just to continue going through the roof. I see another leg up, especially with Facebook and so on and so forth. I'm actually in one of the tech companies. I'm not going to actually get into that, but I'm actually in one of the tech companies. I bought it like a few days ago. And so that's what I'm seeing through there. On the flip side, guys, that to me, GDX and GDXJ and those and Silver, those sort of companies, those sort of sectors out there are not in a bubble yet. And that they haven't even really started to move. If you look at the big picture on those sectors, we've hardly ever moved when it comes to when it comes to the sectors. And if I bring up the charts through here, let me bring up silver and gold. You can see that what I'm talking about. This is the silver and so this is gold, right? Gold is already now starting to go too vertical. So gold is off the ranks. Forget gold right now, guys. It needs to have a bit of a pullback. But look at silver. Silver is just starting to break out now. Nowhere near its highs. GDXJ 50%. Sorry, GDX and the GDXJ. Look at this here. GDXJ is starting to break out now. So gold off the ranks. Tech companies are probably going to continue to go through the roof because we're in a melt up bubble. But on the flip side, the more safer havens are probably this one right here, silver, and the GDXJ, because they really are just starting the bull move. And I do see silver getting above $45 as well too. So that's what I see through there, guys. Let me know what you think about what I've said below, and I will speak to you guys soon. Remember, guys, that if you start to see a lot of things, like for example, we're starting to see a lot of articles about gold. That's getting me a bit nervous about where we are. Probably at the bit of a top right now. I'm seeing a lot of articles out there about the Nasdaq bubble, which is probably telling me that we're probably likely to continue up, at least for the short term anyway. Now, it's not the S&P 500 and the Dow Jones, completely different things. We're just talking about the Nasdaq here. Let me know what you think in the chat box or in the comment section below. Hey traders, John Howell here. Thanks for watching my video. For a limited time only, I am giving away free access to my brand new trading course. I've put all my most powerful systems, strategies, and trading techniques that I've learned over the last 15 years and put it in this course, and I'm giving it away for free for a limited time. See, in this brand new Go to the Markets by the Board trading course, and you can get it when you go to johnsfreegift.com, you're going to learn, firstly, you're going to get access to a brand new training course for 90 minutes, and you're going to learn all the details step by step to my #1 trading system with over a 90% success rate that works on any market and any time frame. You're also going to learn 3 powerful chart reading and trading techniques. You're also going to learn 2 more powerful trading systems, and also you're going to learn 7-figure trading secrets, mindset techniques, and so much more. There's top 13 mistakes you're going to learn, the 10K per month formula, and so much more. No, this is not a get rich quick scheme, but if you are struggling with your trading right now and you need help, then for a limited time, you can get free access to this. So go to johnsfreegift.com right now, or click on the very first thing in the description, because for a limited time, I'm giving away. So go to johnsfreegift.com right now and start getting access to this full complete trading course, plus also the free training with my #1 trading system with over 90% success rate. Go do that right now, and I'll see you on the next page.